Morning, JP.
Good morning, Brandon.
So this is our video where you and I talk about investment themes, but we also bring in our monthly theme.
Right.
This month is November. Today's November 6th,
Correct.
right? The day after the election. And our theme is gratitude. It was always gratitude because it's Thanksgiving.
Yes.
And you and I uncovered an interesting difference between us yesterday.
Yes. So for those of you who don't know, Brandon and I are very different people, which actually is great. It's like opposites attract. It's why we work so well together, I think.
Yeah.
But we were talking about working out and exercise in general. And I found out Brandon is a Zen warrior and likes to work out and lift weights in like total silence.
I never use those words.
That is my interpretation of this.
But yes, I wanted to check out this new club yesterday, or not club. Club.
Yeah, fitness club.
Fitness club. But it was more like a nightclub.
Yeah.
It's just like, and I was like, is it always this loud? He's like, yeah. Would you like to start the tour? And I was like, no. I'm not doing a tour yet.
Right. And I was talking with Andrew about this as well. My favorite dream of all time was blaring 80s hair metal the entire time. You walk in, the guy is a big guy, power lifter, ponytail down across his back. It was just heavy metal all the time.
Help me understand what you like about this, because I don't know. You just mentioned it yesterday.
Sure.
And I was like, I can't.
I don't know. For me, I kind of like to go into the gym and like switch my brain off a little bit and just really lock into the exercise, into like the intensity of it. And I think that when you have like a nervousness, especially with a really heavy weight, the best way to drown that out is to just have like a lot of things going on and just kind of like distract you, right? Because for me, I would psych myself out if it was like totally quiet and I had a really heavy weight to lift. Yeah. And I was like, oh, I could like hurt myself. Or like if you're feeling sore, you can kind of like talk to yourself and be like, oh man, just, only a couple more reps.
Yeah.
But if you just have like loud music or just something really distracting, a lot of people around you, you don't really have the ability to think about yourself. You're kind of just like, oh, my 5 minutes are up. Time to get up and go do the thing again. So for me, it's very good distraction, because if I can outthink myself, and that will lead to negative results.
Okay.
Yeah. That's kind of how I interpret it.
Well, something you know about me, but probably most people don't. I lifted a lot of weights in high school.
Yes, you were a hunk.
I don't know if I was. I had like 3 weightlifting records. I like shattered them all in like a school that was known for that.
Yeah. And
so now I still go into the gym and I do I'm starting to get away from it, but I still do like powerlifting moves.
Yeah.
But I do it for an opposite reason. It calms me down. Like I'm lifting really heavy stuff. And it like it's the literal definition of grounding. It like brings you into the ground. It's like my mind's all up here. And then if I listen to metal, I'd be up here. And I lift these. I'm like, oh, I'm a little too excited. I'm a little too like airy. I'm going to ground with heavy weights. That's what I like of it. And the metal or music or all that is just like, what's happening?
Yeah.
It's too much distraction, which doesn't matter. But what's interesting is, so we talked about gratitude, we talked about grounding, and then we always try to relate this to something in the portfolio. And what grounds our portfolio? Well, probably 2 asset classes. Right?
Yeah, it's stocks and bonds. Those are, it's bonds and cash.
Bonds and cash.
It's the safety. Sorry. The 2 main asset classes we think of are stocks and bonds.
Yeah.
The bonds and cash ground you. They give you that stability.
Yes, absolutely.
Right.
And so I think it's worthwhile to talk about, I don't really have this scripted out, but why bonds are grounding to a portfolio, why they're important, and then maybe what we're seeing in the bond market now, because there's some really interesting things going on. Mortgage rates are up.
Yeah.
Nobody expected mortgage rates to be up.
Yeah.
And then what could happen to bond rates with the new, what's the word I'm looking for?
The new administration.
Thank you. Administration was the word I was looking for.
Yeah. Yes. So a really interesting time with, waking up this morning. Obviously, we had a major election.
Well, let's start at the beginning. Yeah. Why do bonds ground us?
Yeah. Bonds ground us because when you buy a bond and you hold it to maturity, you get exactly what you pay for. Right. Yeah. So if you buy, assuming it doesn't go out of business, the company or the government or wherever you buy this debt from, if it says it's going to pay you 5%, you're going to get 5% if you hold it to maturity. Yeah. So there is a safety there. As long as you're buying high quality, you have good diversification, you kind of follow all the checklist of good portfolio management, you know what you're going to get from it. And if the price goes up or down, it doesn't really matter as long as you're ready to hold out through the future.
And that's the way that we like to buy bonds. We just, we just saw a client with bonds, $5 million portfolio, and $1 million in bond funds.
Yeah.
That doesn't make sense for us in our philosophy. Sure. We've got $1 million that we can buy bonds with. We're going to actually buy real bonds.
Yeah.
And so we know what we're going to get. There's some consistency to it. So if the market's up 20%, stock market's up 20%, is down 20%, we pretty much know where that's going to go.
Right. Right. We have an annualized return baked into our assumptions.
Clearly, and so that's really grounding for our clients. We say, hey, here's some income we know you're going to get.
Right.
Now, there's some exceptions. We trade bonds for certain reasons, but just to keep it simple, there's that. But then a lot of people are saying, I think there's this misconception, this perception that the Fed sets the 10-year Treasury, which is like leading indicator or like influence towards the mortgage rates.
Yeah, it's the number one indicator for it.
And it's just not true. Like people are like learning this harsh reality that, the Fed can't control mortgage rates.
Right. Right. So the Fed can set the current rate, so what all new debt is issued to, and then the market has to dictate what future debt is worth.
Well, it can set the overnight lending rate.
Right.
Yeah.
Right. And so, if you go buy a 7-day note, that is going to be very heavily tied to whatever the Fed says the rate is.
Yeah, it's a short morttage.
Right, but 10 years out, the market gets to decide what is the value of that, right? What does everyone think the future value of debt should be yielding?
Yeah.
And so, rates come down, and that's great, but there are other forces going on in the world that the market has to consider.
Yeah.
And so they can say, rates are coming down, mortgages should come down, and they have. But they don't have to go straight down. They can actually come back up over the short term.
Yeah,
so a lot of volatility in there.
So we talk about the yield curve, and the yield curve, if it's not inverted, goes like this.
Yes.
And this is what the Fed controls, but the rest of this can do everything.
Right.
And looking forward, we don't really know where rates are going to go. Like I've gotten out of the rate prediction business a long time ago, probably like 2012. Like, this is just no longer worth trying to predict.
Yeah.
But the factors that will lead to this rates moving and whether our bonds are, if we're going to get more attractive bond yields or not, whether we're going to get money from our cash or not, is going to be influenced by a lot of the actions that the government does.
Yeah, absolutely. And
outside of the Fed.
Yeah. And what's crazy is like we wake up this morning and we look at the market and two things happen. Stocks are up and bonds were down. Right, well, on a price basis.
Yeah,
so,
on a price basis.
And when prices go down, yields go up. So as buy and hold bond investors, it's actually a great day for us because now we can go in the market, we can get some really good yields. But, no one knew what was going to happen, right? So if you were trying to make a bet of like, in the election, so-and-so is going to happen. Well, the Federal Reserve had nothing to do with that, right? There, like I said, there are greater forces at work. There's people trying to think 5, 10, 15 years down the line.
Yeah, and I want to dissect that because, or as they say now in bros speak, I want to double click on that, JP.
Do they say that?
Yeah, that's the new thing.
Okay.
I want to double click on that.
Okay, yeah.
So wake up this morning, the day after the election, stocks are up, bonds are down.
Yeah.
So why does that happen? Well, people who are holding bonds were like, well, I'm just going to wait to see what happens after the election.
Sure.
Now we know who's going to win. Like Donald Trump will be our next president. And so people say, well, let's look at the past.
Yeah.
So people are thinking, well, he lowers taxes, he increases spending, and he puts pressure on the Fed. That's a lot of juice for the stock market. I'm going to bet on the stock market. This is happening day one. We don't know if this will be a long-term trend. And people say, I'm going to sell my bonds.
Yeah,
right.
That's one of it.
So I'm going to sell my bonds. I need to free up that cash. And then therefore yields go up, but the price of the bonds go down.
Right.
And that's like a normal market when they're inversely related or some type of non-correlation between stocks and bonds.
It's a risk trade. People are saying, hey, if there's going to be more money going into growth, I want to be in growth assets. So they migrate out of security, sometimes into growth. The other thing, too, is a lot of people would say, if Donald Trump wins, maybe he wants a weak dollar. So if there's a weak dollar, there's all kinds of currency reasons why U.S. debt could trade one way versus foreign debt. And so there's a lot of different dynamics in the market where people now have to say, well, there's potentially a new dynamic in the market. I have to readjust all my trades.
Sure. The U.S. is fighting two wars right now overseas in U.S. weapons, or at least U.S. weapons are certainly doing it, and our funding is doing it. And if those two wars escalate, like for instance, North Korea was just seen participating in Ukraine. If these types of wars escalate, then people may get scared. They may sell their stocks, buy more bonds. There could be a flight from safety around the world.
Right.
And like that could definitely impact rates, right?
Yep.
And same thing. So rates would go up, prices would go down. It's not helping mortgages. It's not helping affordability. But those are like, we're talking about a spectrum of outcomes that could occur.
Yeah, definitely. And so what we're going to see over the next week and definitely through the end of the year is earnings are coming out, right? So it's funny because we have an election, sure, that's going to affect the market, but also almost every company in the United States is reporting Q4 earnings right now. So there's a massive story where we're trying to digest how are companies doing, how's the economy doing, and then we also have to say at an institutional level, how are trades going to be placed for the next several years? Because people have to readjust portfolios based on their infinite wisdom and models.
Yeah.
So there's a lot of activity over the next couple of weeks. It'll be really interesting to see where things settle out.
Should be really interesting. What's going to push rates lower?
Pushing rates lower. So there is talk of the Fed continuing towards a 3% target Federal Reserve rate. So sure, in the short term, there could be some volatility at the tail end of the curve. But in the ultra short end, 1 month to 3 years, you're probably going to see bond yields continue to trickle down lower. The other story would definitely be government spending. So if we see any kind of decrease in government spending, we're just going to have less issuance in the market, and we may have some yields increase, just a tighter inventory.
Decreasing government spending.
Yeah, so we'll see. But if we have increases in government spending, we're going to have a lot of offers out there. There's going to be a lot of liquidity in the market, and that can really distort prices.
Yeah, I mean, I think to see prices go lower, you're going to have to see some type of crisis in the market. And like the Fed's already at 2% interest rate, right? Or not the Fed, we're at a 2% inflation rate, 2.1, which is the target. What they consider their neutral rate with interest rates are around 3. I just don't think we're going to like the world we have when we have lower rates.
Yeah, I mean, we loved it for a long time, but now we're seeing the consequences of it. So it'll be interesting to where kind of it settles, right? What is that median rate that kind of makes markets happy, right?
Sure.
There's enough cost of debt where people have to make good, sound financial decisions, but you don't want to have it too high because then people can't build new things.
Yeah.
They can't invest in the future. So it's a very fine line that they have to walk to get us back to a good rate.
Circling back to gratitude, which is our theme, which is a tough one to really work into the markets.
Sure.
I will take a stab at it. This one just came to me. Most of the U.S. population is not invested in the stock or bond market in any meaningful way. And the last 14 years has been a really big boom in markets and has created wealth for a lot of people.
Sure.
And yes, we've had geopolitical turmoil and we might, elections don't always turn out the way people want them to, but there's a lot to be grateful for.
Yeah.
And the ability just to be able to own these types of assets and have some type of taking advantage of the growth of the U.S. Primarily, we talk the U.S. stock market.
Sure.
We look at some international.
Yeah, I don't speak French.
Say what?
I don't speak French, so.
So I think that's one thing to be grateful for.
Yeah, we have a great market, and that great market allows people more financial freedom. So just being able to participate, like you said, is massive. And takes some pressure off you. It takes pressure off people over the long term. They continue to be invested.
Yeah. All right. Well, as long as we can agree that a quiet gym is a better gym.
It's an okay gym.
It's an okay gym.
It's not a bad gym. It's an okay gym. So I still think you go to metal. I agree. If it sounds like a club, if it sounds like Ibiza, I wouldn't like that. But if it sounds
I can't think of a single instance where metal's a good idea.
Oh, dude, it's awesome. Try it. Yeah. I'll give you a playlist. Don't worry.
We'll agree to disagree.
Sounds good.
Let's get to work.
All right.